when we deal with cash budgets, we're actually trying to do some forecasting into the future. So as I said to you before, it's similar to a cash flow statement, which shows what happened, but it is looking into the future, and therefore that can become difficult in trying to predict inflows and outflows. Very similar to the previous type of statement, but we classify it only as estimated receipts, so money coming in, and estimated payments, money going out. Now, cash budgets are vital for the information they give on the timing of payments and the receipts of income, which will be there to identify when we have excess money to invest. This is important, so we put our money to work. Commonly, if you leave money in your normal check account, your operating account, the business might only get, say, 1% or less than 1% interest. So put it to work, put it in the term deposit, buy a new asset, or do something else with it where you can get more income from it. But more commonly, we have a situation where we have a shortfall. Then managers must arrange a way to cover the shortfall in the short term, and by that I mean is that we normally, if it's a short-term deficit, then we go to the bank and arrange a thing called a bank overdraft, which basically means that the bank will allow us to go into the negative up to a certain amount, hopefully only for a short period of time. Now let's have a look at an example of a cash budget. You can see here two main categories: estimated receipts, estimated payments. We had some cash sales, some rental income, so the total income here for these particular months is as shown. Estimated payments, the cost of goods sold, wages, lease of equipment, rent, advertising, lease, loan repayments, admin, electricity, and so on. You can see here drawings for the owners. Now you can see total expenses or total outlays, which is a total of these figures all the way going up to there. Okay, and what we then work out is the estimated income over expenses. This excess is calculated by taking the total income and taking away the total estimated expenses. You can see here we've got a negative figure of 2,250. That's difficult to see in this particular example, but there's the tiny little minus sign. So we initially had 10 grand in the bank, so you can see that by the end of the period the closing bank balance was 7,750, accounting for this deficit. This closing bank balance then becomes the opening bank balance for the next month, and so on. In the next month, in February, we had $37,000 worth of inflows or estimated receipts. The total estimated payments here were 34. So now we're looking at a positive 2,250, which adds to that, and we're back into the 10,000 what we started with. And similarly, we had another positive contribution expected in March. Therefore, we expect to have 14,750 at the end of March. As these are estimated figures, what businesses do, they then compare actual against estimated and do an analysis. And if the variances from any of these months is more than 10%, then they must be investigated and explained why there was such a big deviation. Okay, for example, in March we may have had an actual total income of 30,000. So we thought 40 and the expected, the actual was 30. Why was that the case? And that must be explained and the budget adjusted accordingly for the future months. Again, I come back to this diagram looking at the inflows and outflows, and they are exactly the same in forecasting for the future as they would be for when we deal with them in the cash flow statement. Now, how can we avoid cash shortfalls? If there's a shortfall, then managers must arrange a way to cover the shortfall in the short term. They can arrange a bank overdraft. I mentioned that before. In the short to medium term, they can reduce expenses. Businesses are always looking at ways of minimising their expenses. They can try and increase income, the sales, try and reduce drawings by owners. Sometimes the owners take too much out of the business, or if it's in a really crucial stage, they may choose to decrease their drawings to a bare minimum. They can defer payment of assets, or they might even want to lease assets instead of purchasing them outright, which has a bigger impact on the cash flow in the short term. On the other side, how to deal with cash surpluses. The business must try and use cash for productive purpose. So, for example, they could invest cash or purchase some assets. A new asset could be purchased. Maybe even a business could be taken over, or we could pay back some loans. Or in another instance, we can take some money out for the owners and they can have an extra payment of drawings.